Temporary rate buy downs on mortgages. Is this a scam? Or is it the greatest financial product ever invented? Or maybe it's somewhere in between. In this video, I'm going to break it down. I'm going to show you a real life example. I'm going to explain to you how they work. I'm going to tell you my views as a lender, whether I think they're right or wrong, or maybe just for some people. But there's people on opposite ends of the spectrum. Some preaching this is the key to affordability. Others saying this is a scam. It's an adjustable rate product. Run for the hills. Loan officers that do these are idiots. In today's video, I'm going to talk to you about them. I'm going to explain them to you so you can understand and you can decide for yourself whether or not the temporary rate buy down is something that you'd like to get into. Stay tuned. All right, Matt Gouget, residential mortgage broker, powered by UMortgage. We're licensed in 48 states. We're happy to help. Go to greatmortgagebroker.com. If you want to connect me and my team, we're happy to help you get started. So in today's video, I want to talk about temporary rate buy downs. You might have heard 2-1 buy down, 3-2-1 buy down, 1-0 buy down, temporary buy down. Some people are advertising it as the lender is going to pay for your rate to be 1% lower during the first year. Whatever the case, it's all the same thing. It's temporary rate buy down. In today's video, I want to explain to you exactly what it is so you can understand it for yourself and whether or not it's a scam, like some people say, or whether or not it's a great financial product, which in some markets for some buyers is an exceptional way to go. So first and foremost, I won't go into much detail as I have in past videos. You can go look at 2-1 buy down or buy downs explained to see exactly how they work. But essentially, you get a seller credit, or there's other options where you as the buyer can pay or the lender can pay. But the most common buy down is with a seller credit, where they're crediting you a certain amount of money. You buy down your interest rate and therefore buy down your mortgage payment temporarily. Sometimes it's for 1 year, a 1-0 buy down. Sometimes it's for 2 years, a 2-1 buy down. It can even be a 3-2-1 buy down, or it can be 1-1 buy down, meaning for the first 2 years, it's 1% lower in year one, 1% lower in year two. I'll show you an example so you can see the numbers and see for yourself. Hopefully that will clear it up a little bit, but that is the gist of it, right? And so I'm going to provide an example and then I'm going to tell you a story and let you decide for yourself. All right, here we have it. $500,000 purchase, 10% down. This is what it looks like to have a 2-1 buy down. Now, 7.688. This is not an offer to lend. This is a scenario that we did over the last couple of weeks. But depending on when you're watching this, this might be high for interest rate. It might even be low. If you were to do a 30-year fixed rate loan, and you weren't going to complicate it with these fancy temporary rate buy downs, this is how your mortgage might look. You've got a $500,000 purchase. You've got 10% down. So you've got a $450,000 base loan amount. With that interest rate of 7.688, principal and interest is $3,208 a month. You add mortgage insurance, you add property taxes, you add homeowners insurance. Your total payment is $3,888 a month. You've got some lender costs. You've got some third-party title fees, prepaying taxes and insurance, and your 10% down payment. All in, you're somewhere in the neighborhood of $60,000 out of pocket. And that's what a 30-year fixed rate mortgage would look like. What I'm showing in this example is a $12,000 credit from the seller. $10,807 of this is used to fund what in this case is a 2-1 buy down. Now, $10,807 is what it costs for the buy down. So you've got an extra $1,193 that's offsetting your down payment down here. And so that's factored in as well, that you're getting more than enough credit for the buy down. The remainder is just offsetting your other costs. But what does this buy down accomplish? Well, 7.688 is your rate here. In year one, that's 5.688. And it lowers the payment to $32.87, almost exactly $600 a month. In year two, where it's 6.688, you've got $35.79 a month. And then years 3 through 30, it's still a fixed rate loan at 7.688 for the remainder of the term, right? And so you save roughly $600 in year one, $300 in year two, and then you move on with the loan as is if there's no refinance or anything else, and it behaves exactly like a 30-year fixed rate mortgage behaves, which is where I want to inject. This is not an adjustable rate mortgage. It's a 30-year fixed with years 1 and 2 having the seller buy down supplement the payments to the tune of $600 a month in year one and $300 a month in year two. Then the 30-year fixed for years 3 through 30 just goes on as it always has existed, $38.88 a month, but years 3 through 30, there's no supplement from the seller credit. The seller credit exists in years 1 and 2, and then it disappears. 30-year fixed at its full payment for those years. It's just supplemented in years 1 and 2. So this is not an adjustable rate mortgage. This isn't a mortgage where at any time you're going to look up and have a 10% rate and have your payment be any higher than what it is in this year 3 of $38.88. This is a 30-year fixed rate mortgage with years 1 and 2 having a component which is a seller credit subsidizing the payment, right? Rate buy down. Now, one thing I want to address is that people will say, well, you know what? Let's not take a $12,000 seller credit. Let's just take $12,000 off the price. Again, don't look at the first 2 years. Just look at year 3. And this is what a 30-year fixed rate mortgage will look like. Let's, instead of structuring this whole buy down, just do a 30-year fixed rate mortgage. And instead of paying $500, just say, if the seller's willing to give that, let's just pay them $488 for the house. I understand that argument, but I'm going to show you what the math does. $38.88 at $500. $37.94. Okay. And just looking at this third column, this is what the mortgage would look like for the whole life of the loan. $37.94 a month, $488 purchase price. Congratulations. The same $12,000 you got off the purchase price instead of doing a seller buy down. For those who don't mind this $3,800 payment, kudos to you. For those who aren't payment sensitive at all, kudos to you. Pay less for the house. I agree, right? So those that throw fruit on stage and call me an idiot, just take $12,000 off the price. Here's what I offer to you. If you're a buyer in today's market, you ask yourself, do I care more about the price I pay, $488 versus $500, or do I care more about my comfort level paying this monthly mortgage payment? $37.94 from day one until you refinance or you pay it off or you sell the house, right? That's the payment. It's only $94 a month in savings by lowering the price by $12,000. If you pay $500 and you take the $12,000 in credit, we go back to this scenario where you pay $600 less in year one. I get it. It's temporary. It doesn't last forever. But what does it allow you to do? Ease your way into a new mortgage payment. Maybe you're in the last year of your child being in daycare, and that's going to be paid off. You're going to have a little bit more breathing room in year 2. Maybe you've got a kid you're putting through college, and that's going to be paid off. Maybe you've got 9 months left on your car payment. I don't know what it is, but if it is attractive to you as a buyer, then I don't really care what internet trolls think about a buy down, whether they think that it's a good product or not. If this is more appealing to you, this is an option you have as a buyer. $32.87 in year 2, $32.87 year 1, $35.79 in year 2. And oh, by the way, with the Fed finally realizing that all of their work is starting to push inflation numbers down, What if interest rates go lower next year or the year after? What if you can get yourself a 6.25 30-year fixed rate loan or a 5.75 30-year fixed rate loan 12 months from now, 18 months from now? Guess what happens? Any unused portion of this buy down, because it's going to take 24 months to use up all that subsidy from the seller. If at any point in less than 24 months you refinance, guess what happens to that unused seller subsidy? It comes back to you as a buyer, goes towards the principal in the form of a principal reduction. So you get it back and it lowers what you owe. Because of these reasons, I think that it's not only a viable option, I think it's the option that most buyers are going to choose. And oh, by the way, I close a lot more loans than the average internet troll. So when presenting these options to buyers, they're saying yes. Just like I did here. I would say $488, $37.94 a month, or $500 with 12K credit. Here's what it looks like. I'll let you decide. It's your finances. It's your family. It's your decision. Vast majority of buyers prefer to do it this way. So to the people that say it's a scam, here's what I'll give you. And here's what I'll give everyone. I'll be completely honest. $10,807 of this credit from the seller to the buyer sits in an account that spits off $600 a month in year one, and then spits off $300 a month roughly in year two to lower your payment. Guess what all of this adds up to? You save $10,807 during the first 2 years. So it's not like a magic pill where you get $10,000 in credit and you save $30,000. It's a way of getting the credit from the seller into your escrow account with the mortgage company and giving you a little bit every month as a supplement. As much as people would like to think, I'm in control of my money, you're not going to touch that, that's mine. It's better off in the hands of someone else who says, you know what? Mom and dad are going to hold on to this. We're only going to give you $600 in allowance per month. And maybe I'll offend some people talking like that because they're like, that's my money. But I think that it's useful. And I think it's useful for people to have those constraints. It doesn't mean that, you couldn't handle the money yourself, but putting yourself in that position to just say, you know what? This is how I'm going to ease into it. Going to get a pay raise, going to pay off some debt, going to be in a better position. And then, you know what? If you never get to 38.88 and you just refinance it because rates go to 5.875 and you're able to go, boom, 33.45 a month and just set it and forget it in a 30-year fixed, then you're all good. Just my thoughts. I don't think the 2-1 buy down is a scam. I think quite the opposite. I think it's a very useful tool, especially for first-time home buyers, especially for people who are dealing with affordability issues. So join me in the comments. Some will bash, some will praise. I'm here for all of it because you know what? At the end of the day, luckily, my family loves me. And as much as people might bash in the comments, I see them in the comments quite often, but I never see them at the bank. Thanks for watching. Hope this helped. Bye-bye.